Seeing declining foreign investment after 3 years of strict controls under the zero-COVID policy, China sought to present itself as a market-driven, business-friendly economy in 2023, hoping to lure foreign capital and know-how back to its market. While its external messaging may have changed, the Chinese Communist Party's (CCP) goals to enhance the overall power of China and the CCP have not. The CCP's approach to its external trade and financial relations is focused on promoting self-reliance while bolstering China's influence as an indispensable global sourcing hub. At the same time, CCP leaders are acutely aware of gaps in China's domestic production capacity, where China views attracting foreign research and technology as critical to accelerating industrial advancement. China's continued need for foreign business and finance clashes with a state-centric and security-focused trajectory hastened by General Secretary of the CCP Xi Jinping over the previous decade. State planners continue to use requirements for market access, including requiring companies to form joint ventures with Chinese firms to induce companies into relocating their operations within its borders, enabling the transfer of industry know-how, trade secrets, and technology to Chinese firms. China seeks to diversify and secure its access to critical technologies while striving in the long term to reduce reliance on foreign technology supply chains. China's vulnerabilities were exposed by US-led actions at the end of 2022 to restrict China's access to advanced semiconductor technology. China's domestic semiconductor industry is struggling to develop alternative supplies of chips used in its military and artificial intelligence (AI) applications, though its capabilities continue to advance. Its dominance of the electric vehicle (EV) industry at all stages of the production chain stands out as a rare example of China achieving its self-reliance objectives. Viewing the impact of US and allied economic restrictions on Russia following its unprovoked invasion of Ukraine, Chinese leadership has been vocal about the need to weaken the sanctions power of the United States. As it seeks to reduce its reliance on US dollars in bilateral trade and financial relations, this past year China finalized a range of trade and investment deals with countries, including Brazil and Saudi Arabia, allowing for some settlement in RMB rather than the US dollar, though none of the countries involved have yet reported concluding settlements under the respective arrangements. China has also sought to deepen trade networks with countries beyond the sway of US-led sanctions, including Iran. This section examines key developments and trends in U.S.-China bilateral economic relations and China's other external economic relations. Title 1: The United States' Evolving Approach to Economic Competition with China. Diplomatic engagements with China in 2023 as it messaged the possibility of continued cooperation despite bilateral tensions. After the United States downed a Chinese spy balloon that intruded into U.S. airspace in February 2023, China froze its diplomatic communications with the United States for several months. The Biden administration's efforts to maintain open lines of communication with China resumed in May 2023, when U.S. Commerce Secretary Gina Raimondo met with her Chinese counterpart in Washington. Secretary Raimondo's meeting was followed by visits to Beijing by U.S. Secretary of State Antony Blinken in June 2023 and U.S. Treasury Secretary Janet Yellen and the President's Special Envoy for Climate John Kerry, both in July 2023. Secretary Yellen emphasized that the Biden administration believes it is possible to achieve a mutually beneficial, long-term economic relationship, one that supports growth and innovation on both sides, during her meeting with China's Premier Li Qiang in Beijing. Secretary Yellen also reiterated long-standing U.S. concerns about China's non-market policies. Secretary Yellen's messaging that cooperation can occur in spite of geopolitical tensions reinforces an approach to economic relations with China she laid out in an April 2023 speech. The strategy focuses on investing in U.S. domestic capabilities, increasing supply chain resiliency, and aligning strategies with U.S. allies and partners to shape the environment for sustained U.S.-China competition. Secretary Yellen emphasized that this strategy is narrowly focused on national security risks from China, stating, "Even as our targeted actions may have economic impacts, they are motivated solely by our concerns about our security and values. Our goal is not to use these tools to gain competitive economic advantage." Additional visits by U.S. cabinet officials in 2023, including a trip to Beijing by Secretary Raimondo in August 2023, sought to further clarify the United States' intent to maintain stable commercial relations. The United States has maintained the tariffs imposed under the Trump administration Section 301 investigation as the U.S. Trade Representative, USTR, conducts a review of their efficacy and impact. Under the Trade Act of 1974, USTR has a statutory requirement to conduct a 4-year review of the tariff actions taken under the Section 301 authority, assessing the effectiveness of the action in achieving its objective and the impact on the U.S. economy. The USTR review began in September 2022 and could conclude by the end of 2023. While the details of the review are not yet known, in July 2023 the USTR stated the review will consider the existing tariff structure and how to make the tariffs more strategic in light of impacts on sectors of the U.S. economy as well as the goal of increasing domestic manufacturing. Secretary Yellen indicated that the tariffs are a point of leverage as the United States seeks to address China's unfair trade practices, stating that it's premature to use this as an area for de-escalation, at least at this time. The United States places de-risking at the center of its economic approach in 2023. The Biden administration adopted the G7 concept of de-risking to frame its approach to the national security vulnerabilities stemming from the economic relationship with China. In a May 2023 statement, President Joe Biden and the other G7 leaders committed to de-risking as the basis for their approach to economic resiliency and security. By emphasizing de-risking instead of decoupling, the Biden administration sought to reduce tensions with China and signal its pursuit of objectives it says seek to avoid a broad severance of economic relations and unintended impacts on global commerce. President Biden stated that de-risking further aims to resist Chinese economic coercion, counter Chinese non-market trade practices, and place limits on China's access to a narrow set of advanced technologies critical for our national security. However, the full scope of these technologies has yet to be specified. Administration actions also continue to address forced labor concerns in Xinjiang. According to Secretary Raimondo in August 2023, the United States seeks to allow trade and investment in unrisky areas to thrive, protecting national security while minimizing damage to other commercial relations. Chinese officials attempted to strengthen ties with global businesses and thwart corporate support for U.S. and other governments' attempts to reduce economic ties. In a concerted charm offensive, Chinese officials sought to re-engage global businesses and reduce their concerns about operating risks inside China, hoping to slow corporate efforts to diversify away from China, revive companies' direct investment into China, and potentially diminish business backing for future U.S. policy measures aimed at addressing national security risks. Premier Li vehemently criticized the U.S. de-risking strategy in public comments at the June 2023 World Economic Forum meeting in Tianjin, saying that governments should not overstretch the concept of risk or turn it into an ideological tool and instead should leave addressing risks to the business community. Additionally, since China reopened to international travel at the start of 2023, senior Chinese officials have hosted and met with multiple executives of leading multinational firms who visited China, including CEOs of Airbus, Apple, General Motors, Intel, JP Morgan, and Samsung. In June 2023, Microsoft co-founder Bill Gates met with General Secretary Xi in Beijing, where she expressed China's openness to cooperation and emphasized that China would not be a strong country seeking hegemony. Tesla CEO Elon Musk visited multiple officials during a May 2023 trip to China, including China's then Foreign Affairs Minister Qin Gang, the Ministers of Commerce and Industry, and Vice Premier Ding Xuexiang. Subsequently, in July, Tesla emerged as the only foreign automaker to sign on to a pledge by China's EV industry to avoid a price war and promote core socialist values. The United States is continuing to pursue engagement in Asia through the Indo-Pacific Economic Framework, IPF. The United States launched IPF in 2022 with 13 other partner countries. Biden administration officials have stated that IPF is not intended to be a traditional trade agreement but rather aims to develop high-standard rules on trade in the Indo-Pacific and further goals related to sustainability, labor, and supply chains. The initiative offers an alternative vision of economic engagement to Beijing's own efforts to enhance its regional economic leadership and deepen economic ties. IPF consists of 4 key areas of cooperation, or pillars: 1. Trade, 2. Supply chains, 3. Clean energy, decarbonization, and infrastructure, and 4. Tax and anti-corruption. The initiative does not involve negotiations over market access or tariff liberalization, which critics say will limit its appeal and impact. The IPF Supply Chain Agreement, which was reached on May 27, 2023, marks the first concrete measure under the trade initiative since it was launched a year earlier. IPEF partners announced an agreement on standards and mechanisms designed to bolster supply chain resilience, including by setting up 3 bodies to facilitate cooperation, information sharing, and efforts to coordinate supply chain diversification. The proposed supply chain agreement contains few binding commitments on the 14 IPEF partners, and it may initially spur few substantive initiatives to realign supply chains. Nonetheless, the proposed coordination bodies may still play an important role in building capacity in supply chain management among IPEF partners and businesses, which could help U.S. businesses identify alternative suppliers or production bases to China. The Biden administration seeks closer ties with IPEF members, including Vietnam, as a counterweight to China's growing influence in the Indo-Pacific region. In September 2023, President Biden met with Vietnam's General Secretary Nguyen Phu Trong in Hanoi to establish a comprehensive strategic partnership. The Biden administration seeks to develop trade partners outside of China by furthering U.S. Vietnamese economic cooperation, including efforts to enhance semiconductor supply chain resilience by building capacity in both countries. It is unclear, however, the extent to which developing trade relations with Vietnam will remove China from U.S. supply chains. Following the end of China's zero-COVID policy, Chinese firms began moving production overseas to other countries in Southeast Asia and elsewhere. Vietnamese government data report Chinese firms invested in 45 new projects in the country in the first 50 days of 2023 alone. In addition, nearly 1/3 of Vietnam's imports come from China. China's deep trade and investment relations with Vietnam complicate U.S. de-risking efforts, as U.S. activities with Vietnamese partners may still ultimately depend upon Chinese firms and imports. U.S. targets China's access to advanced technology to curb China's advancements in critical technology. The United States began deploying a targeted strategy based on controlling supply chain choke points. In October 2022, National Security Advisor Jake Sullivan described the Biden administration's approach to restricting technology transfer to China as keeping a small yard, high fence. This approach entailed keeping the scope of technology controls limited, the small yard, while implementing robust measures to prevent circumvention or unauthorized transfers to China, a high fence. In late 2022 and into 2023, the United States coordinated with Japan and the Netherlands to implement an unprecedented export control regime designed to limit China's access to advanced semiconductor technologies. In August 2023, the Biden administration also issued an executive order on outbound investment designed to limit U.S. companies' financial support for China's semiconductors and microelectronics, quantum information technology, and AI industries. U.S. severs China's access to advanced semiconductors. The United States introduced restrictions in 2022 intended to curb China's ability to manufacture and develop advanced semiconductors that enhance its military capabilities, cutting China's economy off from key nodes of the chip industry. On October 7, 2022, the U.S. Department of Commerce Bureau of Industry and Security, BIS, implemented a package of restrictions on U.S. exports of the most advanced computing chips, particularly those relevant to the development of AI and semiconductor manufacturing equipment to entities based in China. The controls do not apply to legacy semiconductors or less advanced chips used in home appliances, automobiles, and many connected devices. In these areas, China is likely to continue dominating production. The consultancy Counterpoint estimated that the restrictions on advanced semiconductor products would only impact about 10% of China's logic chip production through 2025. The restrictions nonetheless led to a steep drop in U.S. semiconductor exports to China. U.S. semiconductor companies exported just $3.1 billion worth of chips to China in the first 8 months of 2023, a drop of 50.7% compared to the $6.4 billion in exports over the same period in 2022. The United States is meanwhile seeking to increase its self-reliance in semiconductors through the implementation of the CHIPS and Science Act of 2022, and the Biden administration is allocating billions in tax credits and funding to industry to incentivize domestic manufacturing. In March 2023, the Departments of Commerce and the Treasury released proposed rules that prohibit CHIPS funding recipients from expanding production capacity for leading-edge chips in foreign countries of concern and place limits on the construction of legacy facilities in those countries. The October 7 restrictions additionally prohibit U.S. persons from helping develop China's advanced semiconductor capacity without first applying for a license exemption, effectively blocking senior U.S. semiconductor engineers and scientists from working on covered technologies at Chinese companies. In response, hundreds of U.S. personnel, including engineers from U.S. semiconductor equipment manufacturers Applied Materials, KLA, and Lam Research who worked as support personnel inside Chinese chip companies, abruptly left core positions inside China's semiconductor industry. The restrictions prompted Chinese companies to intensify their efforts to attract semiconductor talent. China lacks a robust domestic pipeline for training qualified semiconductor engineers and technicians, leaving Chinese chip companies heavily dependent on talent trained overseas. After U.S. chip company Marvell Technology laid off its entire research and development (R&D) workforce in China since late 2022, former employees were quickly headhunted by Chinese semiconductor firms. Similarly, Chinese companies are reportedly offering semiconductor talent in Taiwan 5 times what they could earn domestically. As China's semiconductor industry faced export restrictions from the Netherlands and Japan, Chinese firms rushed to build out capacity by stockpiling equipment from foreign companies. On January 28, 2023, the Netherlands and Japan agreed to align their export control policies with the U.S. restrictions on China's chip sector, pledging to coordinate on controlling China's access to chokepoint technologies like semiconductor design software and lithography, where its indigenously developed technology significantly lags behind the leading edge. Both the Netherlands and Japan are home to the world's leading manufacturers of photolithography machines capable of printing advanced integrated chip designs on semiconductor wafers. Since 2019, the Netherlands has restricted sales to China of extreme ultraviolet photolithography machines, which are solely produced by the Dutch firm ASML. However, neither Japan nor the Netherlands had previously controlled exports of deep ultraviolet (DUV) lithography machines used for mass-producing less advanced chips at the 14-nanometer (nm) node. In July 2023, Japan added certain semiconductor manufacturing equipment, including DUV technology, to its export control list. The Netherlands similarly started restricting exports in September 2023. Prior to these restrictions coming into effect, Chinese companies surged their orders for foreign semiconductor manufacturing technology in 2023, capitalizing on the roughly 8-month lag between when the Dutch government announced its intent to place controls on exports to China and its implementation. Between January and August 2023, China imported $3.2 billion, 23.5 billion renminbi, worth of semiconductor manufacturing machines from the Netherlands, a 96.1% increase over the $1.7 billion, 12 billion renminbi, recorded over the same period in 2022. China's imports of semiconductor equipment from all countries totaled $13.8 billion, 100 billion renminbi, over the first 8 months of 2023 as Chinese companies built up stockpiles. China is on pace to more than double its imports of semiconductor equipment from 2019 levels, when the United States added the Chinese telecommunications giant Huawei to the Entity List and thereby restricted Huawei's access to semiconductor technologies, prompting Beijing to accelerate its push to expand domestic chip manufacturing capacity. Even though Chinese companies mainly acquired equipment capable only of manufacturing older generations of integrated circuits, these stockpiling activities could enable China to deepen its dominance of legacy semiconductors. Chinese companies have demonstrated their ability to produce high-end chips, despite U.S. export controls. In September 2023, Huawei began selling the Mate 60 Pro smartphone, which reportedly uses a Chinese-made chip with features that closely approximate those of U.S.-controlled semiconductor technology. The Kirin 9000s, produced by the Chinese state-owned Semiconductor Manufacturing International Company, SMIC, and designed by Huawei's subsidiary HiSilicon, is capable of connecting to 5G networks and has features consistent with a 7nm chip, a technology that was previously limited to Samsung, Intel, and TSMC semiconductors. An examination of the Huawei phone conducted by experts at Tech Insights confirmed that the device's processor performance means SMIC is just 2 generations behind 3nm technology, which is the most advanced chip currently in production. Experts largely assess Huawei and SMIC's newest production capabilities as a genuine breakthrough, though uncertainty regarding the extent of China's indigenization and production efficiency remains. Chris Miller, author of Chip War, argues that Huawei's Mate 60 Pro may be the most Chinese advanced smartphone ever made given that the phone's primary 7nm processor and many of the phone's auxiliary chips are homegrown, including the Bluetooth, Wi-Fi, and power management chips. These advances have exceeded expectations and also call into question the efficacy of current export control implementation that, as explained by National Security Advisor Jake Sullivan prior to implementation of the October 2022 controls, is intended not only to ensure the United States stays several generations ahead but also to maintain as large of a lead as possible. China's domestic advances in the critical domain of leading-edge semiconductor production raise national security challenges to the United States, given the dual-use nature of the technology and its military applications for AI computer vision, autonomous weapons systems, and other uses. As semiconductor analyst Dylan Patel argues, SMIC's advanced production process is still largely enabled by Western technology, such as immersion DUV lithography machines from ASML, which remain available for China to purchase until the end of 2023, but it is also likely facilitated by porousness in existing U.S. export controls on semiconductor manufacturing equipment. In addition, the phone still appears to be made with several critical non-domestic components. For instance, the phone's memory chips are believed to come from legacy technology produced by the South Korean firm SK Hynix, although the company has denied selling to Huawei since the export controls were introduced. Even amid genuine advances, the continued use of Western semiconductor production equipment and the appearance of non-domestic hardware in the latest phone produced by China's flagship telecommunications firm underscores the country's continued reliance on external producers for advanced technology. China's retaliatory actions against the United States in response to the semiconductor controls were narrowly defined in scope. Beijing sought easy targets for punitive action that would grant leverage and deter further restrictions without incurring significant domestic costs. In 2023, China froze a handful of U.S. companies out of China's market and restricted access to 2 minerals critical to U.S. advanced technology industries. On February 16, 2023, China launched the first salvo of its unreliable entity list by blacklisting Lockheed Martin and Raytheon Missile and Defense Corp., a subsidiary of RTX, formerly Raytheon Technologies, imposing trade and investment restrictions and barring the defense firms from importing or exporting weapons systems in China. As U.S. export controls prevent both companies from selling military equipment in China, the restrictions had little commercial impact. On May 21, 2023, the Cyberspace Administration of China, CAC, determined that memory chips produced by Micron contained significant security risks, banning Chinese critical infrastructure operators from procuring Micron products. The ban, which followed an investigation launched in March 2023, was CAC's first regulatory action targeting a foreign company. Although Micron is a major producer of memory chips inside China, where it generated nearly 11% of its revenue in fiscal year 2022, CAC's restriction will likely have little impact on Chinese companies, given that Samsung and SK Hynix are peer competitors to Micron and sell similar chips inside China. On August 1, 2023, China implemented export controls on gallium and germanium as well as dozens of related products made with those metals, causing shipments to halt as exporters waited to receive dual-use export licenses from China's Ministry of Commerce, MOFCOM. China exported 0 gallium and germanium products in August 2023 to the United States and other countries. On September 21, a spokesperson for MOFCOM stated that the ministry had since granted export licenses for the covered products to several companies, but it did not provide further detail on how many companies could resume exporting, which countries they could export to, or which products were approved. As a result, some exports may resume, but the full scope and long-term impact of these measures remain unclear as of October 6, 2023. China's restrictions could create acute supply shortages for the United States in key technologies. Both gallium and germanium are deemed critical minerals by the U.S. Geological Survey, and they have applications ranging from semiconductors to missile systems to solar panels. China is the world's dominant source of both resources, accounting for 98% of the world's primary production of gallium ore and 60% of its germanium. The United States has limited domestic production and stockpiles of both minerals. The United States, Japan, and Germany may be able to develop alternative supply sources by retrofitting domestic refineries with the capabilities to extract the minerals, but these alternatives may not be operational in time to prevent significant shortages. On September 6, 2023, China banned central government officials and state-owned enterprise (SOE) employees from using Apple and other foreign-branded devices for work purposes and from bringing privately owned foreign devices into government facilities.
Although the Chinese government has denied the existence of such a ban, those familiar with the matter report the government made the move in an effort to cut reliance on foreign technology and limit the flows of data outside of China's borders.
In addition to ostensible security concerns, the new restrictions were announced within days of the release of Huawei's Mate 60 Pro smartphone, discussed above. As a result of the ban, Apple shares lost $200 billion in value just 2 days after the announcement, while state-sponsored Chinese media has reported the Pro Mate 60 is selling out across China. The prohibition on Apple is similar to China's 2021 restrictions on the use of Tesla by military, government, and SOE employees, including a ban on driving privately owned Tesla vehicles in certain government compounds. The Tesla ban was similarly implemented in a stated effort to reduce dependence on foreign technology and prevent data collected in China from moving overseas. De-risking accelerates U.S. corporations are actively seeking strategies to mitigate risks in their supply chains, prompted by their demonstrated vulnerability to policy and market shifts in China. Although China dismantled the COVID-19 controls that had sent its economy into unpredictable lockdowns throughout 2022, U.S. businesses and investors are reassessing the stability of China's domestic policy environment. With Beijing exerting increasing control over the economy and more aggressively pursuing its national security goals, the business environment for U.S. companies has grown harsher. Amid geopolitical tensions, U.S. businesses frequently found their Chinese operations getting caught up in the crosshairs of Chinese restrictions. While many U.S. firms continue to view access to China's market as crucial to growth, a growing number of firms are moving to limit exposure and identify alternative strategies. Bilateral trade reflects deep and continuing commercial ties. The U.S. goods trade deficit with China fell to its lowest reading since 2020, when the outbreak of COVID-19 rattled global supply chains. According to U.S. Census calculations, the U.S. trade deficit with China in the year through August 2023 shrank 33% compared to the same period in 2022, falling to $181.8 billion. This is the lowest trade deficit since 2010.100. The improvement in the trade deficit resulted from a softening of U.S. import demand that began in September 2022 as U.S. consumers shifted spending toward services. However, U.S. data on trade with China may currently overstate the improvement in the bilateral balance. Particularly, U.S. statistical authorities may not capture the full value of China's imports into the United States, partially due to a lack of data on the tens of billions of dollars worth of low-price goods that enter duty-free under the de minimis exception. Data reported by China's Customs Authority show a larger surplus with the United States at $206.4 billion, 1.5 trillion renminbi, in the first 8 months of the year, though Chinese statistics also show a substantial 17.4% decline relative to the same period in 2022. U.S. goods imports from China totaled just $276 billion in the first 8 months of 2023, falling $92.5 billion behind the pace of imports over the same period in 2022. U.S. imports from China are on track to decline compared to 2022, when they reached $536.3 billion, the highest level since the onset of the trade war in 2018. Throughout the pandemic, Chinese factories were allowed to keep production lines open even as municipalities put stricter quarantine provisions in place in an attempt to slow the spread of COVID-19, enabling China's export sector to meet a surge in demand for goods as U.S. businesses and consumers reallocated spending from domestic service industries. However, since the end of 2022 and in the first half of 2023, consumer spending on goods has slowed, causing trade flows to revert back to the mean. The softening in U.S. demand for goods compounded the challenges already faced by China's economy amid a globally weak macroeconomic environment. Slowing economic growth and high inflation worldwide contributed to a slump in global demand for Chinese exports, sapping a key driver of China's economy as falling orders forced Chinese manufacturers to lower production. Despite new restrictions on U.S. technology exports to China, U.S. exports to China remained robust in 2023, driven by strong Chinese demand for U.S. oil, aircraft components, and biopharmaceuticals. Between January and August 2023, U.S. goods exports totaled $94 billion, largely matching the record export amount of $97.1 billion in the first 8 months of 2022. The strong export performance occurred despite a sharp decline in U.S. shipments of semiconductor products and manufacturing equipment resulting from U.S. export restrictions implemented in October 2022. Instead, exports were buoyed by record values of shipments in three industries: oil, aircraft components, and biotechnology.
The United States exported crude oil to China at a record rate in the first 7 months of 2023, sending 103.4 million barrels across the Pacific, an increase of 179% relative to 2022. In value terms, China-bound crude oil exports totaled $7.9 billion in the first 7 months of 2023, increasing $4.7 billion over the 2022 figure. Rather than a surge in domestic demand for oil, which remained subdued as the recovery in China's economy slowed, the uptick was driven by China's smaller independent refiners taking advantage of low crude prices to export refined products or stock up inventories. After international air travel resumed in China following the end of its zero-COVID measures, China's aviation industry faced shortages of maintenance parts, causing it to ramp up orders for parts and components from the United States. U.S. exports of civilian aircraft, engines, equipment, and parts to China in the first 8 months of the year increased 46% year-on-year to a total of $4.7 billion, although this still lagged the pre-pandemic import level of $7.5 billion between January and August 2019. In the first quarter of 2023, biotechnology exports also increased 28.4% year-on-year, totaling $1.6 billion, although this surge tapered off by the middle of 2023. This strong trade at the start of the year was driven by U.S. shipments of immunological products dosed and packaged for Chinese hospitals and consumers, including steroids used to treat asthma. U.S. biopharmaceutical and medicine sales in China have accelerated in recent years as China sped up the regulatory approval process for new drugs. Shortages of drugs inside China in the second half of 2022 likely also created an acute need to rebuild medical supplies after waves of COVID-19 cases flooded China's hospitals and medical centers and increased demand for medicines. Trade war diverted tariffed imports away from China. The composition of bilateral trade has changed dramatically over the 5 years since the United States first imposed tariffs under the Trump administration Section 301 investigations. U.S. industries most exposed to trade actions and geopolitical tensions have shifted toward suppliers based outside of China, a growing portion of which are Chinese companies with overseas operations. The U.S. International Trade Commission estimated that U.S. imports across all Chinese products fell 2% for every 1% increase in the tariff line on each product category. According to analysis by Chad Bown, senior fellow at the Peterson Institute for International Economics, U.S. imports of Chinese products subject to tariff rate hikes were largely flat and remained below 2018 levels. After the USTR issued each of the 4 tariff lists as part of the Section 301 trade actions, U.S. imports of goods subject to tariffs declined. In contrast, Dr. Bang calculates that imports of Chinese goods not targeted by tariff actions were 42% higher in 2022 compared to the 12 months preceding the trade war. Consequently, goods affected by U.S. tariff actions accounted for a declining portion of U.S. goods imports from China, dropping from 67.4% in 2018 to 54% by the end of 2022. U.S. industries ranging from clothing to electronics shifted away from China-based suppliers as they looked to avoid paying tariffs on Chinese imports. The Section 301 tariffs intensified pressure to seek alternative sourcing options outside of China, accelerating a pre-existing trend driven by rising costs of production in China from increasing wages and a declining workforce, among other factors. U.S. importers increased imports from producers in other parts of Asia as well as Mexico. According to global management consultancy Kearney, China's share of U.S. manufactured imports sourced from all low-cost countries in Asia fell to 50.7% in 2022, declining from 65.6% in 2013. In contrast, Vietnam's share of U.S. imports from Asia nearly doubled from its 2018 level of 5.8%. Chinese companies are expanding their presence in Southeast Asian supply chains, increasing U.S. exposure to Chinese content in goods imported from other countries. Even as a rising share of manufactured goods came from outside of China, the amount of Chinese content embedded in these imports rose as Chinese companies expanded their presence in Southeast Asian supply chains. Although the true magnitude of Chinese value-added content in U.S. imports is unknown due to limited efforts to fully map U.S. supply chains, trade and national production data indicate that the manufacturing sectors of ASEAN economies source a substantial share of their intermediate inputs from China.
In Cambodia and Vietnam, products and services originating from China and Hong Kong accounted, respectively, for 20.2% and 15.8% of all value added in the production of exports in 2020. The electronics manufacturing sectors of these countries have become significantly dependent on Chinese inputs, particularly since 2017. In Cambodia's electronics export sector, 50.5% of all inputs originated in China in 2020, rising from 40.1% in 2017, while the share in Vietnam rose to 19.7% in 2020, up from 13.7% in 2017. While these data do not break out these countries' exports just to the United States and therefore cannot reveal the full extent of Chinese products in U.S. supply chains, U.S. imports from these countries have accelerated over the past 6 years. The United States imports from Cambodia rose from $3.1 billion in 2017 to $12.2 billion in 2022, while imports from Vietnam increased from $46.5 billion to $127.5 billion over the same period. The shift in trade was also driven by Chinese suppliers physically relocating to other countries. Chinese FDI in countries including Vietnam, Thailand, and Mexico increased as Chinese exporters sought to move production to low-cost destinations, avoiding the Section 301 tariffs and limiting exposure to future U.S. trade restrictions by setting up manufacturing bases outside of China. The investment activities of Chinese multinational enterprises in Southeast Asia are likely to increase as China seeks to deepen its economic integration in the region, including through the Regional Comprehensive Economic Partnership, the China-initiated trade agreement that came into effect in January 2022. China imposes new restrictions on access to business essential information. Access to reliable market intelligence deteriorated under a far-reaching anti-espionage campaign designed to assert greater party-state control over corporate information flows. Chinese security officials raided 3 multinational corporate advisory firms in 2023, including the U.S. due diligence firm Mintz Group in March and U.S. consulting group Bain & Co. in April. Although Chinese officials did not provide an explanation for the investigations, Chinese state-owned television broadcaster CCTV produced a report on Capvision, a consultancy whose offices were raided by police in May 2023, that alleged Capvision coordinated a network of experts and insiders to sell sensitive information and state secrets. The raids reportedly form part of a campaign to extend the reach of China's national security apparatus and cut off foreign companies' access to information deemed sensitive by the party state. The anti-spy campaign follows March 2023 amendments to the counter-espionage law that went into effect in July. These revisions broaden the definition of espionage activities to include any information gathering that involves material related to China's national security, expanding the remit beyond dealing in state secrets. As restrictions on cross-border data flows went into effect, offshore businesses and investors were cut off from real-time financial and economic data providers and corporate registries. Since 2022, overseas corporations reported that the widely used data provider Wind Information started restricting access to certain data services, including real-time insights into sectors of China's economy ranging from housing to retail sales. Companies also lost access to databases on corporate data registries, including the business databases Kachacha and Tianyanka, as well as Wind's corporate data services, preventing individuals outside of China from easily retrieving information such as the shareholders in a given Chinese company, its affiliated entities, or involvement in legal disputes. The restrictions come as China implements its data governance regime wherein the party state views cyberspace, data, and networks as sovereign territory and subject to local laws and restrictions. The expansive authority of the data security laws is compelling Chinese companies to restrict overseas access to avoid crossing vaguely defined lines. As a result, firms and analysts face worsening information quality on China's business climate, and China's official data releases are curated and manipulated to present a more positive view of the economy. The access restrictions may also complicate foreign companies' ability to comply with home market regulations, particularly sanctions and export restrictions targeting Chinese entities. As a result of the restrictions and the raids, U.S. businesses face greater difficulty in ensuring counterparties in China are not subject to restrictions on exports of controlled technology, U.S. investment restrictions, the Uyghur Forced Labor Prevention Act, and other requirements under U.S. law. Limits on accessing corporate registry data and the series of raids on foreign due diligence and consulting firms mark an acceleration of a long trend of censoring economic information.
China's government has repeatedly imposed restrictions on access to economic data and its collection, censored domestic economic information and news, and punished foreign outlets for coverage of sensitive economic topics. In 2021, for instance, China's government censored independent indicators of inflation to control news about sharp price increases, and in 2023 it suspended a government dataset on youth unemployment after the rate for urban 16 to 24-year-olds climbed to an all-time high of 21.3% in June 2023.
In 2012, China's government also blocked Bloomberg and Businessweek's websites after they published a story on then Vice President Xi Jinping's family wealth.
U.S. direct investment in China slows amid rising risks. Many U.S. businesses delayed or reconsidered investment in China amid a weak economic outlook, causing FDI in China to tumble in 2022. Just 45% of U.S. companies surveyed by AmCham China in its 2023 Business Climate Survey plan to increase their investment plans in China, the lowest proportion in the business survey's history. Among those companies expanding investment, most planned only small increases. The drop in planned investment contributed to FDI flows into China falling to a record low, extending a multi-year slowdown in direct investment. Across U.S. and other foreign companies, greenfield FDI flows, including investments in new factories and facilities, dropped to $17 billion in 2022, 43.3% below the flows in 2021. FDI in 2023 has proven equally dismal, with just $3.2 billion in new greenfield investment transactions in the first quarter of 2023, declining 34% year-on-year from the first quarter of 2022 and down 75% relative to 2021. Total direct investment inside China, including both mergers and acquisitions and greenfield FDI by all foreign companies, fell to its lowest recorded level of $41 billion in 2022. Beijing's prioritization of national security undercut the party-state's message of openness to foreign investment and led U.S. businesses to consider reducing or isolating their operations in China.
In March 2023, China's newly appointed Premier Li tried in his first major public remarks to reassure global businesses, saying that China strives to create a first-class business environment that is market-oriented, rule-of-law-based, and internationalized.
China's government carried out a series of initiatives in 2023 to attract foreign investment, hoping that foreign capital inflows will help revive the stagnant economy. China's MOFCOM even launched its Invest in China Year campaign in 2023, organizing a series of events to attract foreign businesses.
Provincial and local governments also rolled out tax incentives for foreign investors.
Despite this overture to international business, a rising number of U.S. companies have indicated that they plan to reduce their presence inside China. According to AmCham China's April 2023 flash survey of U.S. businesses in China, 23% of surveyed businesses are relocating parts of their operations or assessing their options to do so. Businesses cited tensions in the U.S.-China relationship and geopolitical risks as the number 1 and 2 challenges to their operations inside China. In contrast to surveys in previous years, survey respondents elevated their concerns about exposure to policy volatility and the party-state's national security economic narrative. Concerns about the Chinese policy environment and increasing Chinese protectionism and or economic nationalism also rose to U.S. firms' third and fourth largest challenges. Emerging supply chain vulnerabilities in the electric vehicle industry. A decade of government support has made China's EV market into the world's largest and led to a surge in Chinese exports across the broader category of new energy vehicles and EVs.
In the first 7 months of 2023, China's EV exports alone increased 119% over the previous year. China is now the world's largest EV exporter. In 2022, Chinese EV exports accounted for 35% of global EV trade, although a majority of China's EV exports were produced by foreign automakers manufacturing inside China, either through wholly owned foreign enterprises or via joint ventures with Chinese automakers. Tesla alone made up 40% of China's total EV exports.
Western multinational EV manufacturers have established export hubs inside China, aiming to lower production costs by operating within China's dynamic EV ecosystem. In contrast to overseas sales, foreign brands make up only a small portion of China's own EV market, where domestic manufacturers are driving the rapid expansion of Chinese EV sales. In 2022, sales of EVs and other NEVs inside China totaled 6.9 million vehicles, nearly double the sales in 2021. Despite the slowing economy, NEV purchases between January and August 2023 continued to rise 40% year-on-year as the government stepped in to boost auto purchases using tax exemptions. Currently, 1 in 4 passenger vehicles sold in China is at NEV, up from 1 in 20 in 2019.
Made in China EV exports to the EU have boomed over the past 2 years, prompting the European Commission to launch an anti-subsidy investigation into China's EV industry.
On September 13, 2023, European Commission President von der Leyen announced that the EU is launching an anti-subsidy investigation into EVs exported by China, stating that China is distorting the EU market by keeping prices artificially low by huge state subsidies.
The investigation formally launched on October 4, 2023.
The EU's review of China's non-market EV practices is in the context of deepening ties between European and Chinese automotive sectors.
Europe has absorbed most of the surge in China's exports of EVs.
The EU is on track to more than double its imports of EVs from China in 2023 relative to 2022 as China's shipments of vehicles continue to accelerate.
The EU imported $6.2 billion, €5.8 billion, in EVs from China in the first 7 months of 2023, a 125.8% increase over the same period in 2022.
Made in China EVs make up a growing fraction of EU sales. Imported EVs from China accounted for 11.2% of all EVs sold in Germany in the first half of 2023.
European automakers are simultaneously expanding production into China.
Because the EU maintains low tariffs on EVs and European purchases, subsidies are available regardless of the vehicle's country of origin. European automakers, including BMW, Mercedes, and Renault, are offshoring production to China, including through joint ventures with Chinese automakers, as they aim to lower the costs of producing cars bound for both the Chinese and European markets.
For instance, BMW has produced and exported its 9.3 battery EV through a China-based joint venture with Brilliance since 2020. The EU's most senior trade official, Valdis Dombrovskis, stated that the EU's anti-subsidy probe may extend to foreign automakers' China operations if they are receiving production-side subsidies from China. Should China escalate trade tensions in response to the EU's anti-subsidy review, Europe's auto sector may also be exposed to trade costs or retaliatory measures.
Chinese automakers currently hold only a small share of the EV market outside of China, but they are investing heavily in expanding their overseas footprint. China's most popular domestic EV brand, BYD, is now the world's largest EV producer and is rapidly expanding overseas. Between January and August 2023, BYD reported 117,500 in overseas NEV sales, making up 16% of China's total NEV exports over the same period. BYD has already doubled the 56,000 in overseas vehicle sales it recorded for all of 2022, which were primarily exported to India, Thailand, and Brazil. It expects to ramp up sales to 400,000 vehicles in 2024, aiming to leverage its low-cost EVs to enter not only developing economy markets and also increase sales to markets such as Japan and Europe. It aims to send 30,000 vehicles to Mexico by 2024.187. China's automakers are also seeking to move production closer to overseas markets. Since 2016, BYD and Geely, the Chinese owner of Volvo and Polestar, have announced 14 and 15 greenfield projects outside of China, respectively.
Chinese EV manufacturers have made limited entries into the U.S. market.
Aside from BYD's success in manufacturing and selling electric buses in the United States, Chinese automakers have largely avoided the U.S. market due to high tariffs on imported passenger vehicles from China and the smaller size of the U.S. EV market relative to that of Europe.
A handful of exceptions exist.
The premium EV manufacturer Polestar plans to start production in the United States at a new facility in South Carolina in 2024, which will be the Chinese-owned automaker's first production facility located outside of China. U.S. automaker General Motors plans to introduce its Buick Electra EV model, which it currently produces for sale in China, to the U.S. market in the next 2 years. Ford also has a partnership with Contemporary Amperex Technology, CATL, the world's largest battery supplier, to invest $3.5 billion into a lithium iron phosphate battery factory in Michigan. CATL is also expanding its operations in other markets, including in Europe, where it is projected to be the region's largest battery maker once its factories in Germany and Hungary come online, potentially as early as 2025. Foreign portfolio investment in China. U.S. financial services companies reassess their strategies in China. Some foreign banks and investment firms have started reducing their footprint as their ventures struggle to gain ground in China's state-owned bank-dominated financial system. As China took significant steps since 2018 to open its financial services market to foreign investment, including reforms it committed to implement nearly 20 years earlier when negotiating its entry into the WTO, U.S. financial institutions made ambitious investments to expand their China operations. Foreign fund managers, banks, and insurers that entered under newly available channels encountered financial markets that were saturated by Chinese state-owned financial services companies, many of which leveraged joint ventures with foreign firms to bolster internal expertise and financial acumen, leaving global funds with just a margin of the market. At the end of 2022, U.S. holdings of Chinese stocks and bonds totaled $247.2 billion, a small fraction compared to the $29.3 trillion, 212.3 trillion renminbi, in total market capitalization on the Shanghai and Shenzhen stock exchanges alone. While some foreign fund managers like BlackRock and Fidelity remain committed to competing for market share in China despite declining profitability, other U.S. financial firms are drawing back from China. Vanguard is reportedly preparing to exit its financial advisory joint venture with Ant Group and close its office in Shanghai, 4 years after launching the venture in 2019. In April 2023, the U.S. mutual fund VanEck abandoned its plan to set up a unit in China's mutual fund market. Of the total U.S. holdings, 4 of the largest U.S. banks operating in China, J.P. Morgan, Citigroup, Bank of America, and Morgan Stanley, cut their combined China exposure by 16% in 2022, holding just $48 billion inside China. Even as some foreign financial institutions withdraw from or reduce their footprint in China's market, Chinese regulators are greenlighting more foreign-owned fund managers. Since late 2022, the China Securities Regulatory Commission, CSRC, accelerated approvals for wholly foreign-owned mutual fund and wealth management businesses in China, potentially increasing foreign firms' ability to seek profits in China's still developing financial system. In November 2022, the Canadian asset management firm Manulife received approval to buy out its Chinese partner's stake in a joint venture fund, becoming the first financial institution to convert a joint venture into a wholly foreign-owned entity since China removed the cap on foreign ownership in this sector in 2020. The CSRC subsequently approved J.P. Morgan's bid to take over its mutual fund joint venture in January 2023. At the same time, it granted the United Kingdom, UK, based bank Standard Chartered approval to set up a fully foreign-owned securities brokerage. In February, Morgan Stanley received approval to take full control over its asset management joint venture. Prior to the recent string of approvals, 4 other U.S. firms received approval to establish wealth management and/or mutual fund businesses: BlackRock and Goldman Sachs for majority-owned wealth management joint ventures in May 2021, and Neuberger Berman Group, Fidelity, and BlackRock for wholly owned mutual fund businesses in September 2021, August 2021, and August 2020, respectively. While gaining full control over a fund may grant foreign financial institutions greater flexibility, they will still face a Chinese financial market landscape dominated by state-backed players with deep capital pockets. Chinese regulators remain apprehensive about foreign financial services companies gaining too much influence, especially as China creates new markets for financial services. Regulations on entry to China's emerging private pension market favor domestic firms, creating a barrier to nearly all foreign companies entering without a Chinese partner's support. U.S. asset managers are also creating distance from their China-based operations as U.S. regulators increase their scrutiny of investments in China. Sequoia Capital, whose China venture capital unit has backed many of China's major tech startups, announced in June that it will split its China operations into an independent company alongside a planned restructuring that carves out its operations in India and Southeast Asia. Sequoia's $56 billion in assets under management in China will be placed in a new entity called Hongshan. This exceeds the $53 billion in Sequoia Capital's assets under management in the United States and Europe combined. Hongshan may still be able to raise funds from U.S. investors following the completion of the business separation. U.S. government restrictions on investing in Chinese companies tied to China's military-civil fusion strategy, as well as the potential implementation of Washington's outbound investment review mechanism, may reduce the opportunities for investing in China's technology sector. U.S. investment managers are also increasing scrutiny of investments that could be seen as bankrolling China's military. China's securities regulator formalizes an approval process for overseas listings in the United States. At the end of 2022, China permitted U.S. regulatory inspections of China and Hong Kong-based auditors for the first time, a step that brought over 100 U.S.-listed Chinese companies into compliance with U.S. securities law and removed the possibility of a mass delisting. Prior to these investigations, the Chinese government had prevented the Public Company Accounting Oversight Board, CAB, a non-profit corporation established by Congress to oversee the audits of publicly traded companies listed on U.S. exchanges, from conducting inspections of auditors based in mainland China and Hong Kong as mandated under the Sarbanes-Oxley Act of 2002. Under a process established in the Holding Foreign Companies Accountable Act of 2018, HFCAA, issuers that retained auditors from such non-compliant jurisdictions for several consecutive years would face a trading prohibition on U.S. securities markets. The Securities and Exchange Commission identified 174 issuers, including Alibaba, the largest Chinese company on U.S. exchanges by market capitalization, that were non-compliant with the provisions of the HFCAA in fiscal year 2021. However, after successfully completing a round of regulatory inspections of 2 audit firms in mainland China and Hong Kong in late 2022, the CAB retracted its determination of China and Hong Kong as non-compliant jurisdictions on December 15, 2022. This reconsideration by the CAB means that Chinese companies do not currently face the risk of a trading ban under the HFCAA. It further cleared the way for new listings by companies that retain China and Hong Kong-based auditors, leading to a brief revival of listing activity in the first quarter of 2023. In the first 3 months of 2023, 13 Chinese companies listed on major U.S. exchanges and raised a combined total of $376 million through initial product offerings, IPOs. Although Chinese overseas IPOs rebounded at the start of 2023, listing activity stalled as the CSRC formalized oversight and regulatory control over Chinese companies going public on foreign stock exchanges. Chinese overseas IPOs ground to a near halt after March 31, 2023, when China's securities regulator revised its approval process for companies going public overseas. Under the new review mechanism, all companies are required to register their listing with the CSRC, enabling regulators to block any proposed listing that violates China's laws and regulations or poses risks to national security and the CCP. Though the CSRC touted the measures as necessary for enforcing regulatory compliance and preventing fraud, its review process is wide-ranging, including an evaluation of the company's safeguards against disclosing what the party state views as state secrets. The new approval process forms the latest element of Beijing's evolving regulatory regime for overseas listings, which expanded rapidly since 2021 as the party state increased oversight of cross-border data flows. After ride-hailing app Didi Chuxing proceeded with its blockbuster $4.4 billion IPO in June 2021 despite objections from CAC, China clamped down on new listings as it deployed new review mechanisms for overseas IPOs, including a mandatory data review process introduced by CAC in February 2022. Overseas listings by Chinese companies in all sectors had slowed to a drip in late 2021 and 2022. The CSRC's introduction of an approval process for all overseas listings in 2023 is likely intended to reopen a pathway for companies that align with Beijing's economic priorities to raise capital on foreign markets. Consequently, Chinese IPOs may increase on U.S. exchanges as the CSRC completes its approval process, which is reportedly taking upward of 6 months. Firms operating in industries deemed sensitive by the CCP are likely to face increased scrutiny when applying to list overseas. Listings of Chinese companies utilizing variable interest entity structures, VIEs, may accelerate under the CSRC's revised overseas IPO approval process, potentially magnifying the risks to U.S. investors. Since the early 2000s, hundreds of Chinese companies, particularly those in the internet sector, have listed in the United States using VIEs, complex corporate structures that grant shareholders contractual claims to control via an offshore shell company without transferring actual ownership in the company, to circumvent China's restrictions on foreign ownership in industries the CCP deems sensitive. Prior to 2023, Chinese companies that list overseas using a VIE were not required to register their listings with the CSRC, as the VIE is not considered a Chinese company under China's law.
In its March 2023 implementation of an overseas IPO approval mechanism, the CSRC established a requirement for companies to register and receive permission before going public overseas through VIE structures.
On September 14, 2023, the Chinese auto insurance platform Cheche Technology became the first company formally approved by the CSRC to list using a VIE arrangement on the Nasdaq, potentially signaling Chinese regulators' intent to accelerate such listings. Although the VIEs received recognition from China's security regulator in its March 2023 rules, these corporate structures still hold only dubious legal status under China's laws, and the enforceability of a VIE's contractual arrangements is unproven in Chinese courts. Foreign investors may have little recourse to enforcement in the Chinese legal system if VIE-listed companies take the company private at lower valuation or if businesses fail. China leverages bilateral debt to promote its national interests externally in the wake of a global economic downturn and following 10 years of extensive and predatory lending under the Belt and Road Initiative, BRI. 2022 and 2023 saw a mounting wave of sovereign financial distress among developing countries holding debt from China's policy banks. China has been and continues to be a primary contributor to this nascent crisis through its extensive and poorly regulated bilateral lending relationships with risky borrowers. In many ways, rising debt distress across developing countries represents the culmination of China's long-standing, irresponsible lending practices. In response to this crisis of its own creation, China seeks to leverage debt troubles in international events to expand the use and reach of the RMB through currency swap lines. In addition, China is expanding its energy partnerships with countries across Central Asia and the Middle East to increase its energy access and security while insulating itself from U.S. economic statecraft. In the long run, developing debt troubles, de-dollarization, and China's expanding partnerships with Russia and energy-producing states will reduce China's sensitivity to U.S. sanctions, grow developing and resource-rich states' ties to and dependency on China, and increase international competition for energy resources. Rising distress among countries holding loans from China. A record number of countries that borrowed from China are in debt distress due to high interest rates, heavy loan burdens, and worsening global economic conditions. Nearly 60% of China's debtor nations were in financial distress in 2022, up from just 5% in 2010.
Borrowers with adjustable interest rates have been particularly vulnerable due to inflation.
For instance, Argentina's semi-annual payments on a $4.7 billion loan from China increased from $87 million in January to $137 million in July 2022. Many borrowers with low interest rates are also facing distress as their gross domestic product, GDP, falters and the burden of external debt payments becomes unmanageable. In 2021, Zambia's external public and publicly guaranteed debt-to-GDP ratio was 133%, and of the $20 billion in external public debt, an estimated one-third was owed to China alone.
China is not providing sufficient debt relief to distressed borrowers.
Despite repeated requests by the United States, World Bank, International Monetary Fund, IMF, and other democratic and developed partners, China refuses to offer broad and substantial debt relief or restructuring to developing countries in distress. In August 2022, China canceled 23 loans to African countries in an attempt to address rising financial distress and narratives surrounding China's debt trap diplomacy. These cancellations accounted for less than 1% of the debt African countries owe to China, and most of this forgiveness went to 20-year-old defaults, loans that were long since unlikely to be repaid. Moreover, of the 54 countries in Africa, China is known to have lent to 51 of these countries in the past 2 decades. Among these borrowers, 18 are at a moderate risk of external debt distress, 12 are at a high risk of distress, and 7 are currently in distress. China's primary strategy for dealing with distressed borrowers has been to extend loan maturity, as it did with a $2 billion loan to Pakistan in March 2023 and as it offered for an undisclosed amount of debt owed by Sri Lanka in February 2023. Rolling over loans gives borrowers more time to repay but may also prolong and increase the borrower's debt burden. More recently, China has extended emergency loans to distressed countries. Between 2018 and 2021, China offered Pakistan and Sri Lanka, 2 major BRI partners in significant distress, more than $26 billion in emergency loan funding. Emergency loans offer a way for countries to continue funding productive ventures that may facilitate future loan repayment, but they also grow the debt these countries already hold.
In addition to not providing sufficient relief to most borrowers bilaterally, China sometimes impedes multilateral efforts to restructure financially distressed countries' debts, as it did in Zambia. In 2020, Zambia's external public debt stood at $18.7 billion and central government debt was 103% of GDP. As its foreign reserves were rapidly eaten by loan payments, Zambia requested relief through debt restructuring. While most creditors, including the United States, were willing to coordinate relief, China, which held one-third of Zambia's debt, refused to participate. China instead insisted on confidential bilateral debt negotiations that would bar Zambia from discussing the terms of the deal. Without China's participation, creditors were unable to develop a comprehensive relief plan. Zambia depleted its foreign reserves and defaulted on its debt in November 2020. China did finally agree to debt restructuring in 2022, but only after it became a co-chair of Zambia's creditors committee with France. In June 2023, Zambia secured a multilateral agreement to restructure $6.3 billion in debts owed to foreign governments, including China. The country's debt will be rescheduled over more than 20 years with a 3-year grace period during which time only interest must be paid. Although a deal was eventually secured, China's initial refusal to participate in multilateral negotiations prolonged and potentially worsened Zambia's financial situation. China continues to free-ride on international efforts to alleviate distressed countries' financial burdens by continuing unsustainable lending in the wake of multilateral debt relief efforts. For instance, China has continued to lend to Honduras, which has received substantial debt relief through several multilateral programs. In 2003, Honduras had $556 million in debt forgiven as part of the IMF and World Bank's Heavily Indebted Poor Countries Initiative, representing a 17.8% reduction in the Honduran government's total debt. This relief was followed by an additional $141 million in IMF debt forgiveness under the Multilateral Debt Relief Initiative in 2005 and $1.4 billion provided by the Inter-American Development Bank in 2007. As a result of these efforts, Honduras' external debt stocks as a percentage of gross national income fell from 81% in 2000 to 27% in 2010. In taking advantage of Honduras' new fiscal health, Chinese lenders began increasing loans to the country. From 2010 to 2021, China's share of Honduras' external bilateral debt increased from 2% to 16%. In addition, many of the loans China provided came with interest rates well above the IMF's concessional rates. In 2014, while the IMF was offering around 1% interest on loans to low-income countries, China extended a $298 million loan to Honduras at 4.1% interest. Honduras' debt to gross national income (GNI) percentage has increased steadily with Chinese lending, reaching 45% by 2021. In 2023, even as Honduras finalized an agreement with the IMF for a 36-month credit facility for $830 million to support economic reforms, the Latin American country also entered into negotiations with China for financing for a new $20 billion rail line. Often, this lending also comes with political benefits for China. Negotiations on rail line financing for Honduras were initiated shortly after the country switched diplomatic recognition from Taiwan to Beijing earlier in 2023. China has an established pattern of lending to heavily indebted poor countries, HIPC, participants following their initial participation, with the majority of Chinese loans to Comoros, the Republic of the Congo, Côte d'Ivoire, Guinea, Liberia, and Togo occurring after these countries completed the program in the early 2010s. With the notable exception of Côte d'Ivoire, all of these countries have publicly supported China's conduct in the South China Sea and most have supported China's policies in Hong Kong and Xinjiang. China primarily accounts for borrower risk by offering high and adjustable interest rates on loans, which tend to exceed rates provided by Western governments and multilateral institutions. In addition, China typically does not disclose the terms of its loans, which makes it difficult for developing borrowers to directly compare interest rates across lenders. A recent working paper by AidData, Harvard, the Kiel Institute, and the World Bank estimates interest rates on China's emergency loans are 2.5 times above the IMF's rates. Moreover, China often provides high-interest loans despite a borrower's pre-existing debt burden. In February 2023, China extended a $700 million loan with an undisclosed interest rate to Pakistan to float the country's economy as it navigates a debt crisis exacerbated by rising inflation and a series of floods. This funding is in addition to the estimated $100 billion Pakistan owes to international creditors and $30 billion it owes China specifically. China's ability to provide comprehensive debt relief to distressed overseas borrowers is significantly limited by mounting domestic economic challenges.
Forgiving loans requires lenders to accept heavy losses, but banks in China are already under pressure due to the country's slowing economy, declining home prices, and stalled real estate market.
In addition, the government of China itself faces a debt crisis.
The IMF estimates China's total government debt stands at 121% of GDP in 2023, a figure that includes hidden borrowing done through financing companies set up by Chinese municipalities and provinces. Moreover, China's long-awaited post-COVID-19 recovery has been slow in coming. Deflationary pressures are mounting amid weak demand, pushing China's central bank to ease policy. While reduced lending rates can spur consumption and economic growth, they will add further pressure to China's banks, which are already struggling to maintain profitability.
Despite a recent decline in new overseas lending, China remains a key financer for many developing borrowers.
According to the Inter-American Dialogue's China-Latin America Finance Database, Chinese policy banks lent $813 million to Latin America and the Caribbean in 2022 after extending a single new loan valued at $204 million to Trinidad and Tobago for the purchase of vaccines and medical equipment in 2021. This financing includes $500 million to Brazil from the China Development Bank and $192 million and $121 million to Guyana and Barbados, respectively, from the Export-Import Bank of China. In addition to increasing its volume of debt holdings, China remains a creditor for its current outstanding loans, which tie borrowers to China for the duration of repayment. For example, loans on two China-funded infrastructure projects in Bangladesh, the Karnathuli River Tunnel and the Padma Bridge rail link, will enter into repayment in November and December of 2023. Due to the terms of these loans, many of which carry maturities of at least 20 years, China will maintain its position as lender to Bangladesh for at least another 2 decades.
China's deepening economic relationship with Russia-China has tossed an economic lifeline to a strategic partner, buffering Russia's economy from international sanctions and enabling its unprovoked war in Ukraine to continue.
Trade between China and Russia reached a record high of $179 billion, 1.3 trillion renminbi, in 2022, rising 30% year-over-year. Trade further accelerated from January to September of 2023, rising 32% over the same period in 2022. Though China has been Russia's largest trade partner for 12 years, bilateral trade expanded significantly in the 6 months following the invasion. China accounted for 35% of Russian imports between March and September 2022, up from 20% over the same period in 2021. Similarly, 20% of total Russian exports went to China between March and September 2022, up from 15% in 2021. Since the implementation of sanctions on Russia from the United States and its allies, China has seized on the short-term opportunity to purchase cheap commodities from its isolated, resource-rich neighbor, especially oil and gas. China more than doubled its imports of Russian liquefied petroleum gas, LPG, in 2022, and China's oil imports from Russia reached a record level 1.66 million barrels per day in January 2023. Russian imports of Chinese semiconductors, a critical dual-use technology, jumped from $200 million in 2021 to more than $500 million in 2022, though Beijing has reportedly refrained from selling Russia its most advanced chips, those deemed strategically important, such as the Lunxin processors. Agricultural trade also expanded, with total Russian exports of agricultural products to China worth $7 billion in 2022, up 41% year-on-year. In a demonstration of long-term strategic ambitions that build on the recent acceleration of trade, Russian President Vladimir Putin and Xi Jinping met for a 2-day bilateral summit in Moscow in March. In the past, Xi has referred to Putin as his best and bosom friend, and the two leaders of the nominally non-allied countries with a no-limits friendship reaffirmed their commitment to deepen relations under the Comprehensive Strategic Partnership of Coordination for the New Era. The framework seeks to move forward development goals and insulate the economies of both nations from further economic restrictions imposed by the United States and its allies and partners, as well as advance the multipolarization of the world. Chinese companies have moved to capture market share in Russia in the wake of multinational corporations' exodus. Although over 1,000 multinational firms have exited Russia since February 2022, many Chinese companies have stayed and expanded operations while being cautious not to run afoul of international sanctions. Chinese car companies and consumer electronics companies have significantly expanded their market share in Russia, with automakers Chery, Great Wall Motor, and Geely claiming 16.5% of passenger car and small commercial vehicle sales in Russia during 2022, up from just 6.3% the year before. Other foreign automakers pulled out of the country and several domestic firms had to suspend production after being unable to acquire parts due to economic restrictions. Chery alone increased its sales in Russia by 31% in 2022, even though total new car sales in Russia dropped by 59% for the year. Similarly, Chinese smartphone maker Xiaomi increased its market share from 45% in 2021 to 80% in 2022, and Huawei displaced HP to become the second largest seller of notebook computers in Russia. In April, the U.S. Commerce Department added 12 Chinese companies to the entity list for supplying dual-use technology to Russia, including 3 HC Semiconductors Company Limited, Win Electronics Company Limited, and Yongli Electronic Components Company Limited. In June, the EU followed suit by adding 3 Chinese companies to an entities list included in its 11th sanctions package against Russia. Then in late September, the Commerce Department sanctioned 9 Chinese entities for supplying parts and aerospace components to Russian and Iranian suppliers of unmanned aerial vehicles used by Russia's military, followed by 42 additional Chinese entities on October 6 for supporting Russian military production, including through the sale of U.S.-origin microelectronics used in Russian precision-guided missiles. Beijing is leveraging its advantageous negotiating position with Russia to lock in favorable terms on long-term sources of energy, agricultural products, and raw metal inputs for its industries. At the Xi-Putin summit in March, Russia committed to deliver at least 98 billion cubic meters (BCM) of gas a year to China by 2030, a more than 6-fold increase of what Russia sold to China in 2022. President Putin publicly stated that all parties had concluded all agreements on finishing Power of Siberia 2, an approximately 1,600-mile pipeline from the Yamal Peninsula that would reroute gas traditionally bound for Europe across Mongolia to China and add 50 BCM of annual gas transport capacity, slightly less than the now-defunct Nord Stream 1 pipeline that linked Russia to Germany. In a sign that China is holding out for a better deal on Power of Siberia 2, subsequent official statements from Xi made no mention of agreements on the pipeline. Russia appeared to quickly walk back its stance, issuing a revised statement saying that pipeline details still need to be resolved. In May 2023, Russia announced it would vastly increase grain exports to China via the new Land Grain Corridor, a transportation and storage network first proposed by Beijing in 2012. Despite the fact that Russia was the largest exporter of wheat in 2021 and China was the largest importer, China imported only 12,274 metric tons of 26 million metric tons Russia exported that year, or roughly 0.05% of Russia's total. Russia has committed to increase that number to 8 million metric tons, or near one-third of total Russian exports, once the new land grain corridor comes online. She has recently emphasized the need for China to diversify its food supply amid domestic climate shocks and rising trade tensions with the United States, calling agriculture a foundation of national security. The RMB's incremental advance in global finance. Though the RMB is far from displacing the US dollar as the global reserve currency, mechanisms that enable increasing use of RMB in certain payments help to shield countries targeted by US sanctions while providing other countries the ability to circumvent sanctions. According to 2023 second quarter data from the IMF, the US dollar comprises 59% of all allocated foreign exchange reserves, while the RMB comprises just 2.5%. This puts the RMB well behind the euro at 20%, the yen at 5.4%, and the pound at 4.9%, and roughly equivalent to the Canadian dollar at 2.5%. Although small in scale, the presence of the RMB in international reserves challenges the United States by offering an alternative currency to countries seeking to circumvent US and Allied-imposed sanctions. This includes direct targets of sanctions, such as Russia and North Korea, as well as third parties looking to continue limited exchange with targeted states. For instance, in the past year, India and Pakistan have both used RMB to pay for some imports of Russian oil, while Bangladesh agreed to use RMB to settle payment for a nuclear power plant being built by the Russian state-owned Rosatom. Small-scale transactions like these have little impact on RMB internationalization in the aggregate, but they do impact the economic and strategic calculations countries make when assessing if and how to respond to US sanctions.
Despite this limited usage, China is nevertheless opportunistic and quick to leverage geopolitical events and economic trends to further RMB internationalization. Following the imposition of Western sanctions in response to the invasion of Ukraine, Russia has become increasingly reliant on China as an import source and export destination, a fact China has capitalized on by increasing the use of RMB in its trade with Russia. The RMB's share in Russian import settlements rose from 4% to 23% in 2022, and now nearly all Chinese purchases of Russian commodities, including oil, coal, and some metals, are settled in RMB. To accommodate this growing trade, China's commercial and policy banks have begun building out their capacity to facilitate RMB-based cross-border transactions with Russia, including by promoting the adoption of China's cross-border interbank payment system, CIPS. Russia also appears to be embracing the RMB. At the start of 2023, the Russian Finance Ministry began selling RMB instead of US dollars and what it deems other unfriendly Western currencies. The ministry also developed a new structure for the country's sovereign wealth fund to hold 60% of its assets in RMB, including proceeds from oil and gas. As a result, the Chinese RMB effectively replaced the US dollar as the most traded currency in Russia in February of 2023, but only in Russia, thus affecting only a minimal fraction of global US dollar transactions. China's willingness to help international rule-breakers like Russia sidestep U.S. sanctions decreases the efficacy and deterring power of this key tool in U.S. economic statecraft. In addition to Russian gas, the RMB is now being used to settle some oil trades between China and countries across the Middle East at an increasing, albeit limited, rate. During his December visit to Riyadh, Xi told Gulf Cooperation Council leaders that China would work toward buying energy commodities in RMB instead of the dollar, seeking to make full use of the Shanghai Petroleum and National Gas Exchange as a platform to carry out RMB settlement of oil and gas trade. To that end, in 2023, China settled its first liquefied natural gas (LNG) purchase in RMB, with the state-owned China National Offshore Oil Corporation (CNOOC) purchasing 65,000 tons of LNG from the United Arab Emirates through the French firm Total Energies. While Iraq still settles its oil deals in US dollars, in February 2023, the Iraqi central bank stated it would allow non-oil trade with China to be settled using the RMB. Despite these developments, the US dollar is still used in 80% of global oil sales, and Saudi Arabia, which sells more than 25% of its total oil exports to China, trades exclusively in US dollars. Although it is unlikely that any oil-producing country will shift any large portion of settlement from the dollar to RMB in the near term, the growing presence of the RMB in economic exchanges could lay the foundation for a potential transition. China is using finance instruments like currency swap lines as an opportunity to incrementally expand the RMB's use and centrality among China's trading partners and financially distressed countries. A currency swap line is an arrangement between two central banks to exchange currency in order to provide foreign currency liquidity to domestic banks without dipping into foreign reserves. Through a swap line, a central bank can borrow RMB from the People's Bank of China and lend these funds to local banks that in turn lend to firms engaged in commercial relations with China, with funds typically used for goods trade, Chinese construction contracts, or investment into Chinese government bonds. Drawing funds through a swap also bolsters foreign exchange reserves, which may help prevent a balance of payment crisis wherein a country is unable to pay for essential imported goods and services due to a lack of foreign currency liquidity. Such swaps can thus be an attractive option for indebted countries with substantial engagement with China. As of 2021, China has established swap lines with at least 38 countries, amounting to $544 million outstanding, with a preference for countries that have significant export exposure to Chinese goods. These swap lines tend to be infrequently used, particularly in comparison with U.S. swap lines. Nonetheless, the swaps speak to China's evolving efforts to more thoroughly interconnect countries around the globe to its own sphere of influence. The incremental advance of the RMB may further the development of alternative financial payment infrastructure, increasing China's ability to mitigate financial sanctions. At the same time that marginal RMB use allows China to exert more influence over its trading partners and debt-distressed countries, it also creates impetus for these countries to participate in alternative financial infrastructure that specializes in RMB settlements, namely China's CIPS. Cambodia provides an example of how incremental RMB internationalization may promote the use of CIPS.
China has long been one of Cambodia's largest financial contributors, but the country's economic reliance on China intensified after the two signed a free trade agreement in 2020.
According to figures provided by China's General Administration of Customs, Cambodia's trade deficit with China nearly doubled from $6.6 billion in 2020 to $12.4 billion in 2022. In addition, China is Cambodia's largest trading partner overall, producing one-third of all the country's imports. Cambodia's rising purchases of Chinese imports intensified its demand for RMB, likely motivating the central bank's decision to join CIPS, which was announced in February 2023. By using CIPS, China's trade settlements with Cambodia will fall outside of payment systems controlled by the United States and its allies, thus insulating these transactions from U.S. and partnered sanctions. Despite rising use of the RMB, China still faces limitations when it comes to effectively mitigating the impact of U.S. and multilateral financial sanctions, most obviously the trillions of dollars worth of assets it holds in U.S. and allied markets. China is moving to increase Argentina's use of the RMB as that country experiences severe and prolonged economic challenges with few viable alternatives.
China and Argentina have participated in currency swap line agreements every year from 2008 to 2021.
The frequency and value of these swaps along with the use of RMB in external transactions have increased as Argentina's debt and domestic economic turmoil have intensified in the past 5 years. Argentina's external public debt reached $394 billion by February of 2023, with at least $17 billion in loans being funded by Chinese banks between 2005 and 2019. A drought earlier this year caused a sharp drop in Argentina's agricultural export revenue, and a survey of analysts conducted in May by Argentina's central bank forecasts an annual inflation rate of 149% for 2023. These factors, coupled with Argentina's unsustainable debt burden, series of defaults on its sovereign bonds, and high global interest rates have exacerbated devaluation pressure on the Argentine peso and limited the country's ability to build up its foreign reserves. In need of substantial and sustained liquidity injections to alleviate some of this pressure and with few options available, in April 2023, Argentina announced it would start purchasing $1 billion worth of Chinese imports in RMB as a measure to relieve the country's dwindling dollar reserves. Argentina also renewed and extended its swap line agreement with China in June 2023, doubling the amount of funds accessible to nearly $10 billion. China plays on the desire of third countries for strategic non-alignment in the mounting U.S.-China geostrategic competition, offering the RMB as a competitive alternative to the U.S. dollar.
Brazil offers an example.
In 2018, Brazil held no RMB in its foreign reserves. By the end of 2022, however, the RMB accounted for 5.4% of central bank holdings, making it Brazil's second largest currency reserve behind the dollar. China is Brazil's largest source of imports and largest destination for exports, with bilateral trade between the two valued at $157 billion in 2022. Agricultural exports from Brazil play a particularly important role in bilateral trade, with China purchasing $48 billion in agricultural products in 2022, including nearly 70% of Brazil's total soybean exports.
In March 2023, Brazil and China reached an agreement to conduct bilateral trade and financial transactions in their own currencies, the RMB and the real. Although Brazil and China have not yet publicly settled any bilateral trade using either currency, the scale of the two countries' agricultural trade lays the foundation for a substantial shift away from the US dollar and toward the RMB if they were to begin settling transactions with the RMB or the real. Moreover, during his visit to Beijing in April, Brazilian President Luiz Inácio Lula da Silva called on other developing countries to replace the dollar with domestic currency in trade. At the BRICS, Brazil, Russia, India, China, South Africa summit in August 2023, Brazil's finance minister Fernando Haddad suggested that Brazil and Argentina could settle bilateral trade using RMB, although no actions have yet been taken in this direction. A member of BRICS and one of the largest developing countries in terms of GDP and population, Brazil's limited but growing interest in de-dollarization highlights the potential long-term impact gradual RMB internationalization may have on the United States' ability to coordinate sanctions across third countries. China's expanding energy partnerships. China's import demand for energy commodities, including gas and oil, has increased as its economy marginally rebounds relative to its performance during COVID-19.
China's oil demand topped 16 million barrels per day in April 2023, up from 12.7 million barrels in April 2022, as cheap Russian crude feedstock bolstered Chinese refiners' production. China further benefited from international limits on Russian crude imports by selling a portion of the newly refined oil to countries that imposed the ban, including Australia, Canada, the EU, Japan, the UK, and the United States. Similarly, China's imports of natural gas rose to a 5-month high in June 2023, and the International Energy Agency forecasts China's gas consumption in 2023 to increase by more than 6% relative to 2022. To spur growth, meet demand, and fortify energy security against potential sanctions, China has sought to expand its trade relations with existing oil and gas suppliers in Central Asia as well as establish new relations with resource-rich actors across South Asia and the Middle East, including Qatar and the Taliban in Afghanistan. China's preference for partnering with high-risk and autocratic countries helps to sustain and stabilize these governments while offering a viable path to circumvent U.S. leadership and U.S. economic statecraft. China seeks to finalize long-stalled negotiations on an expansion to the Central Asia gas pipeline to insulate itself from U.S. sanctions while bolstering energy security and supply. Turkmenistan is currently China's largest overland supplier of natural gas, able to provide 55 billion cubic meters (BCM) of energy annually through lines A, B, and C of the Central Asia-China gas pipeline. China has sought to expand this supply through BRI funding for a fourth, Line D, which would provide an additional 30 BCM of gas annually to China.
In the decades since an agreement was reached on the expansion, the pipeline, like so many BRI projects, remains incomplete.
This year, China renewed its efforts to complete the project by prioritizing construction on Line D as a way to secure gas inflows from its long-term overland partners, although it remains to be seen if any substantial progress is made. In addition to greater supply, the pipeline's overland delivery system and location increases China's energy security, since Turkmenistan is unlikely to participate in US-led sanctions given the economic significance of gas exports to China for its economy.
China is also developing new energy partnerships with Gulf states and South Asia, including entering into a drilling contract with the Taliban.
In November 2022, China and Qatar agreed to a $60 billion 27-year contract for LNG.
The deal would export 4 million tons of additional LNG to China annually.
In terms of access to oil, China has renewed overtures to access Afghanistan's natural resources, particularly in the energy and mineral sectors, following the United States' withdrawal from Afghanistan.
In January 2023, China's state-owned Xinjiang Central Asia Petroleum and Gas Company signed an agreement with Taliban leadership to drill for oil in Afghanistan in January 2023.
China eases overt coercion as it increases overtures to Europe after years of mounting aggression in its external economic relations. In 2023, China moderated its use of overt coercion against developed countries. Beginning in 2016 and reaching a peak in 2020, economic coercion has been an oft-used tool of Beijing's foreign policy, applied against both developed and underdeveloped nations alike. Although China's use of overt coercive tactics has moderated in the past 3 years, between 2020 and 2022, the Australian Strategic Policy Institute recorded 73 instances of attempted coercion by China. Notably, China's recent application of coercive tactics tends to focus on wealthier countries, with 2 attempts on Eswatini and 1 on Brazil and Bangladesh standing out as exceptions.
China's declining use of overt coercion is likely driven by several factors. First, there are increasing multilateral efforts to counteract China's economic intimidation, including the G7's Coordination Platform on Economic Coercion and the EU's Anti-Coercion Instrument. Second, China is attempting to improve its international image following years of aggressive diplomacy and its poor handling of the COVID-19 pandemic.
In the past year, she has attempted to charm the heads of foreign states, notably European leaders, in an attempt to win international supporters while dividing potential coalitions of opposition. Finally, China's economic coercion has also backfired at times, causing significant consequences for China. For instance, its informal ban on Australian coal in response to Australia's call for an investigation into the origins of COVID-19 may have partially contributed to a coal shortage and subsequent series of blackouts across China in the summer of 2021, while Australia was able to sell the coal to other buyers. Continued trade restrictions against imports from Taiwan in the lead-up to Taiwan's 2024 elections constitute a notable exception to China's otherwise moderated approach to coercion. China has hosted leaders from developed countries in an attempt to revitalize economic ties, but Beijing's refusal to offer substantive concessions, including taking steps to foster a level economic playing field and market reciprocity and to provide decisive statements condemning Russia's unprovoked war in Ukraine, has undermined the campaign's effectiveness. Between November 2022 and April 2023, she hosted leaders from Germany, Spain, France, and the EU in an effort to smooth over relations following Russia's unprovoked invasion of Ukraine and potentially restart the currently stalled Comprehensive Agreement on Investment. She did not make any substantial concessions following these meetings, however, beyond a brief call to Ukraine's President Volodymyr Zelensky in late April 2023 following the repeated requests of European leaders. In December 2022, Australian Foreign Affairs Minister Penny Wong visited Beijing, marking the first time an Australian minister had done so in 3 years. In discussions with her counterpart from China, Minister Wong raised issues of human rights and trade blockages as well as the need to manage tensions between the United States and China. In February 2023, Australia's and China's trade ministers held talks to ensure the timely and full resumption of trade following China's imposition of sanctions in 2020 on a range of Australian goods, including coal and wine, in response to calls by then Prime Minister Scott Morrison for an investigation into the origins of COVID. China partially reversed course on coal by allowing Australian imports back into the country in January 2023, although significant sanctions remain on a variety of goods.
Despite its softening approach in 2023, China continues to strengthen formal legal channels through which to implement coercive tactics.
In July 2023, China implemented a new and sweeping foreign relations law aimed at countering trade sanctions by the United States and its partners and allies. The law builds on China's 2021 anti-foreign sanction law, which prohibits companies operating in China from complying with foreign sanctions.
China specifically takes issue with U.S.-led export controls on semiconductors and U.S. efforts to reduce reliance on Chinese suppliers in critical sectors.
In the new legislation, China made several thinly veiled references to coercion and sanctions, reiterating its intent to take corresponding countermeasures against actions that it perceived as endangering China's sovereignty, security, and development interests. 402 In an effort to communicate U.S. policy on export controls and deepen discussion on persistent economic issues between the United States and China, U.S.
Commerce Secretary Raimondo recently announced the creation of an export control enforcement information exchange platform with China.
The platform aims to reduce misunderstanding of U.S. national security policies by China, with the first meeting held in August 2023.